How do billionaires like Elon Musk and Warren Buffett pay little to no taxes? It's not because they're breaking the rules, it's because they're playing a completely different game. Today, we're diving into the controversial world of legal tax avoidance. By the end of this video, you'll understand how the wealthy use loopholes, offshore accounts, and smart financial strategies to minimize their tax bills, and what it means for the rest of us. Stay with us as we revealed how the wealthy avoid taxes legally. Don't forget to like and subscribe for more insights into the billionaires' lives. Welcome to the world of high-stakes tax strategy, where the ultra-wealthy use every tool in the book to legally reduce their tax burden. From offshore accounts to charitable foundations, the methods they use are perfectly legal, but often misunderstood. So let's pull back the curtain and explore how the wealthy avoid taxes, why it's allowed, and what it means for the economy. 1. Offshore accounts and tax havens. Let's start with one of the most well-known and controversial financial strategies, offshore accounts. Wealthy individuals and corporations often move their money to tax havens like the Cayman Islands, Switzerland, Bermuda, and Singapore, where tax rates are significantly lower, or in some cases, non-existent. This allows them to legally reduce or avoid taxation in their home countries, helping them accumulate and preserve their wealth. But offshore banking isn't just about hiding money. It's about leveraging international tax laws to their advantage. A billionaire, for example, might establish a shell company in a tax-friendly jurisdiction. This company, in turn, holds their assets, shielding them from higher tax rates back home. They can report lower profits or income in their home country, significantly reducing their tax burden. Some even relocate their businesses on paper, making it appear as though their earnings are generated in a low-tax region, even if their operations remain elsewhere. However, this practice remains highly controversial. While it is technically legal, critics argue that it undermines public trust and deprives governments of critical tax revenue needed for infrastructure, healthcare, and education. Governments worldwide have attempted to crack down on offshore tax avoidance, introducing transparency laws and agreements to close loopholes. But despite these efforts, the ultra-wealthy continue to find ways to stay ahead of the system. For billionaires, offshore banking is more than just a tax strategy. It's a core part of their financial playbook, ensuring their fortunes remain protected, no matter how strict tax laws become. 2. Capital gains versus income tax. Let's break down a major tax advantage that the wealthy use: the difference between income tax and capital gains tax. While most people earn money through salaries or wages, which are subject to high income tax rates, the wealthy make most of their money through investments, which are taxed at much lower rates. For example, in the United States, the top income tax rate is 37%, meaning that a high-earning worker could be losing more than a third of their paycheck to taxes. However, long-term capital gains, profits made from selling investments like stocks, real estate, and businesses, are taxed at a much lower maximum rate of 20%. This means that billionaires who primarily grow their wealth through investments often pay less in taxes than middle-class workers. Warren Buffett has famously pointed out that he pays a lower tax rate than his secretary because most of his earnings come from capital gains rather than wages. But here's where it gets even more strategic. Instead of selling their investments and triggering capital gains taxes, the ultra-rich borrow against their assets. By taking out loans using stocks, real estate, or businesses as collateral, they can access millions or even billions of dollars in cash without having to sell anything, meaning they don't owe any capital gains tax. Since loans are not considered taxable income, they can effectively live off borrowed money while keeping their wealth invested and growing. This strategy allows the wealthy to minimize their tax burden, keep their assets appreciating, and access cash without paying the same high tax rates as everyday workers. It's a powerful financial loophole, but one that's out of reach for most people. 3. Charitable foundations and tax deductions. Now let's talk about charitable foundations. Charitable foundations play a dual role in society. While they support meaningful causes, they also serve as a strategic financial tool for the wealthy. Philanthropy is often seen as an act of generosity, but behind the scenes, it's also a highly effective tax strategy. When affluent individuals donate to their own charitable foundations, they can deduct these contributions from their taxable income, significantly lowering the amount of taxes they owe. This allows them to retain greater control over their wealth while simultaneously positioning themselves as benevolent benefactors. However, the real advantage lies in the control they maintain over these foundations. Unlike direct donations to independent charities, when billionaires like Bill Gates or Warren Buffett contribute billions to their own foundations, they still have a say in where the money goes, how it is managed, and which causes it supports. This ensures their philanthropic efforts align with their personal values and interests, whether it be education, healthcare, or climate change. While this system does fund important global initiatives, it is not without controversy. Critics argue that these foundations often serve as vehicles for maintaining family wealth and influence under the guise of philanthropy. In some cases, administrative costs and salaries for family members or close associates are covered by the foundation, allowing wealth to stay within their inner circle. Moreover, since foundations are only required to distribute a small percentage of their assets annually, vast amounts of money can remain untouched for years. Despite the ethical debates, charitable foundations remain a crucial component of wealth management. For the rich, they provide tax relief, legacy building, and sustained control over their charitable endeavors. Whether viewed as a genuine act of goodwill or a financial loophole, their impact in society is undeniable. 4th, real estate and depreciation. Finally, let's talk about real estate. Real estate is one of the most powerful wealth-building tools for the rich, not just because of property appreciation, but because of the significant tax advantages it offers. High net worth individuals and corporations use real estate investments strategically to minimize their tax liabilities while growing their wealth over time. One of the most effective tax benefits they leverage is depreciation, which allows property owners to deduct the cost of wear and tear on their buildings from their taxable income. Here's how it works. A billionaire who purchases a $50 million commercial property can claim annual depreciation, often around $2 million per year, even if the property is actually increasing in value. This deduction significantly reduces their taxable income, allowing them to keep more of their earnings while benefiting from real estate appreciation. What makes this strategy even more advantageous is that depreciation is a paper loss, meaning it reduces tax liability without requiring the investor to spend any actual money. But it doesn't stop there. When the time comes to sell the property, they can avoid immediate capital gains taxes by using a 1031 exchange, a legal provision that allows them to reinvest the proceeds from the sale into a new, like-kind property, deferring taxes indefinitely. This creates a cycle where investors continually upgrade their real estate holdings without paying taxes on their gains, compounding their wealth over decades. While this strategy is entirely legal, it's often criticized for allowing the ultra-wealthy to minimize their tax contributions while accumulating vast real estate empires. Nonetheless, real estate remains a cornerstone of wealth preservation, offering appreciation, passive income, and tax benefits that give investors a significant financial edge. For those who understand the system, it's not just about owning property, it's about mastering the tax code to build generational wealth. So how do the wealthy avoid taxes legally? It's all about understanding the rules and using them to their advantage. From offshore accounts to charitable foundations, capital gains to real estate depreciation, The strategies they use are perfectly legal, but often controversial. While these methods might seem out of reach for the average person, there's a lot we can learn from them. Whether it's optimizing your investments or exploring tax deductions, small steps can make a big difference. If you found this video eye-opening, don't forget to like, subscribe, and hit that notification bell. Because in our next video, we're diving into the economics of luxury brands. And trust me, you don't want to miss it. See you there.